The digital universe is currently running up against a brutal, unyielding physical constraint that Wall Street financial models spent decades completely ignoring. For years, retail investors on Reddit and stock influencers on YouTube treated semiconductor companies through a lazy, monolithic lens. Chips were simply cyclical commodities, silicon widgets manufactured in bulk, destined to suffer through predictable boom-and-bust inventory gluts every 3 to 4 years. If demand slowed down for consumer smartphones or standard laptops, memory makers were written off as dead money. But that superficial framework has been shattered by the unyielding realities of modern artificial intelligence infrastructure. With Micron Technology trading dynamically around the mid-$900 following an astronomical multi-100% surge over the past year, the market is finally waking up to a profound technical truth. The absolute bottleneck of the artificial intelligence era is no longer just raw arithmetic processing power or the number of floating point operations a graphics processor can churn out. The true bottleneck is the agonizingly slow speed at which data can be moved, shuffled, and fed into those hungry processors. This is the realm of the memory wall, the physical, inescapable speed of light limitation of how fast electrons can traverse traditional silicon architectures. When a hyperscale data center clusters tens of thousands of advanced AI accelerators to train a massive frontier model, those processors sit starved of data if the memory subsystem cannot keep pace. Traditional planar dynamic random access memory, the kind that powered decades of personal computing, simply cannot clear the traffic. Standard memory architectures lack the sheer bandwidth density required to sustain modern deep learning workloads. This brings us directly to the hidden structural reality that standard financial media commentators and casual retail investors continually miss. High-bandwidth memory is not just an upgraded version of standard DRAM, it is an entirely different class of advanced microelectronic engineering. By vertically stacking multiple DRAM dies using microscopic vertical interconnects called through-silicon vias and fusing them directly to a base logic die via advanced 2.5D and 3D packaging, manufacturers create a superhighway of data. This architecture allows thousands of parallel data channels to flow simultaneously, obliterating the traditional memory wall and slashing power consumption per gigabyte transferred. Yet building these ultra-dense memory stacks is an absolute manufacturing nightmare. It requires microscopic alignment tolerances measured in fractions of a micron, pristine cleanroom environments, and multi-billion-dollar capital outlays that weed out weak competitors. While retail traders chase daily headlines about superficial macro data, institutional heavyweights are quietly pricing in a permanent structural shift. Memory has transitioned from a commoditized hardware component into a priceless strategic intellectual property asset. Hyperscale cloud providers like Microsoft, Google, Amazon, and Meta are no longer bargaining on price, they are fighting tooth and nail for guaranteed supply allocations. When Micron reported its jaw-dropping fiscal third-quarter results, revealing revenues that quadrupled year-over-year to nearly $42 billion and gross margins soaring past an unprecedented 81%, it wasn't just a cyclical beat, it was a definitive declaration that high-end memory is the lifeblood of the global intelligence economy. The company's entire 2026 high-bandwidth memory supply was completely sold out under strict multi-year customer agreements, with billions of customer prepayments flooding the balance sheet before the silicon even leaves the wafer fabrication facility. Yet retail psychology remains trapped in the old paradigm. Every minor macroeconomic pullback or fleeting sector-wide de-risking event sends social media feeds into a tailspin, with amateur traders panicking over short-term valuation multiples, while institutional accumulation quietly absorbs every available share. Before we dive deeper into the multi-billion-dollar supply chains and the geopolitical chess match shaping this supercycle, let's ground this conversation in reality. How are you personally playing the current semiconductor landscape? Are you aggressively accumulating quality assets during market dips, or are you sitting on the sidelines waiting for a deeper correction? Drop your thoughts in the comments below, and let's break down the mechanics driving this historic market movement. To fully grasp why Micron commands such a pivotal chokehold over the modern technology landscape, one must strip away the outdated historical framing that plagued the stock for decades. For most of its history, Micron was unfairly lumped into the cyclical doldrums of legacy consumer electronics. Wall Street analysts modeled its fortunes around the retail PC upgrade cycle, consumer smartphone adoption rates, and low-margin commodity DRAM pricing swings. In that bygone era, a sudden oversupply of standard memory chips could trigger an instantaneous price collapse, plunging gross margins into the red and leaving management teams scrambling to service massive debt loads incurred during plant expansions. That historical narrative is entirely obsolete. The modern Micron Technology is a mission-critical infrastructure titan powering the data-centric architecture of the 21st century. The company's operational segments have undergone a radical metamorphosis, driven by high-margin demand vectors spanning cloud data centers, enterprise artificial intelligence clusters, advanced automotive systems, and next-generation mobile devices. Look closely at the structural breakdown of Micron's business units. The Cloud Memory Business Unit and the Core Data Center Business Unit have emerged as juggernauts of profitability, fueled by an insatiable corporate appetite for high-bandwidth memory solutions like HBM3E and the rapidly ramping HBM4 generation. These aren't the low-margin memory sticks found in a desktop computer. These are intricately engineered, custom-integrated silicon stacks that require unprecedented coordination between memory designers and elite processor architects. Furthermore, Micron's Mobile and Client Business Unit and Automotive and Embedded Business Unit have decoupled from traditional consumer cyclicality. Modern smartphones are no longer simple communication tools. They are localized edge AI devices running on-device large language models, requiring massive leaps in low-power, high-density DRAM and high-speed NAND flash storage. Similarly, modern electric and autonomous vehicles function as rolling data centers, demanding automotive-grade memory capable of withstanding extreme thermal environments while processing terabytes of sensor telemetry in real time. By shifting its product mix away from commoditized low-end parts and aggressively prioritizing high-value technology-leading nodes, Micron has fundamentally re-engineered its financial profile. Operating margins that historically hovered in the low single digits during down cycles have expanded dramatically, proving that the company's structural pricing power during supply deficits is far more potent than legacy models ever accounted for. This operational transformation is anchored by massive multi-year strategic customer agreements. Rather than exposing 100% of its production volume to the volatile spot market, Micron has locked in a significant portion of its advanced DRAM and NAND output through long-term contracts featuring guaranteed floor prices and customer-backed capital commitments. These agreements provide an unprecedented revenue shield, ensuring that even if macroeconomic headwinds temporarily cool broader IT spending, Micron's baseline cash generation remains exceptionally robust. Yet navigating this hyper-growth environment is not without formidable operational challenges. The capital expenditure required to maintain technological leadership in semiconductor manufacturing is astronomical. Micron's management team has aggressively raised its capital expenditure forecast, pumping billions into state-of-the-art facilities like the massive advanced packaging and wafer fabrication expansion in Singapore, designed to secure long-term manufacturing resilience. This brings us to the complex competitive landscape and the multi-year outlook that will determine whether Micron can sustain its dominance. While Micron has executed brilliantly, ramping its HBM4 offerings at twice the speed of previous generations and securing coveted multi-billion-dollar supply slots inside the supply chains of elite AI accelerator designers like NVIDIA, AMD, and custom hyperscale silicon teams, the global memory market is fiercely contested by memory giants Sky, Hynix, and Samsung, with each player aggressively jockeying for allocation share inside the supply chains of elite AI accelerator designers like NVIDIA, AMD, and custom hyperscale silicon teams. In the NAND flash segment, international competitive dynamics are shifting rapidly, with emerging competitors scaling up shipment volumes and adding global capacity. This means that while DRAM pricing and high bandwidth memory scarcity remain the primary profit engines for Micron, maintaining pricing discipline across the entire portfolio requires flawless operational execution. Geopolitical risks and supply chain vulnerabilities also loom large over the semiconductor ecosystem. Advanced semiconductor manufacturing relies on an extraordinarily delicate globalized web of